Well, Austin, again, we're super excited about having you with us today in the Quad Cities, especially in this kind of Q&A format. It's a little bit different than we've done in the past, but I think it's going to be actually more compelling this year. You know, I appreciate your strong background, not only as an economist, professor, TV host, but also as a journalist. You won the 2006 award for exemplary journalism. So understanding or explaining complex issues simply is what we're going to kind of dive into today. So let's start off just making sure everybody's on the same page. Help the audience fully understand the Federal Reserve System and its dual mandate of low interest rates and low unemployment, and then follow that up and talk a little bit about the differences between monetary and fiscal policy, please.
How long is this lunch?
Well,
that's where we're going to start. Okay, look, the Federal Reserve Act is established in 1913 to establish the Fed, to promote and protect financial stability. Came out of the panic of 1907, and established the monetary policy of the United States. Monetary policy is we kind of set the interest rates. One particular interest rate, short-term interest rates. Fiscal policy is everything else the government does. Every taxes, spending, regulations, a bunch of things that are outside of the financial space and the interest rate space. They set up the Federal Reserve to be as independent of political interference as it's possible to be in a democracy. So the Federal Open Market Committee, there's 19 people who sit around the table. There's a kludgy, weird voting rules of who gets to vote at different times. There are 7 political appointees of the Board of Governors in Washington, D.C., that they're chosen by the president, confirmed by the Senate, to 14-year terms that are staggered. So nobody gets to dominate the choice of that. And then there are 12 reserve banks sprinkled around the country. And a lot of times people say, why does Chicago even have a Fed? And Iowa is in the 7th district of the Chicago Fed. We got 50 or so people work in Des Moines from the Chicago Fed, a lot of them bank supervision. The reason why there are 12 reserve banks is because way back then, just like today, people did not want Washington, D.C. plus Wall Street to control the entire financial system of the United States with no input from the rest of the country. So they put 12 banks that come with a regional perspective around that table, and we meet every 6 weeks. And if I always say, if you're an econ nerd, that's about the coolest thing there is in the world. You go to this meeting, there's a humongous table, biggest table I've ever seen in your life. They bring down the shades so nobody can spy on what's being said, and then they're going to go around the table. Jay Powell, here's what Jay Powell thinks about the economy. Here's what the governors think. Here's where they go one by one. The Federal Reserve table goes through the state of the economy and what the rates should be. And we have a dual mandate, we call it. The law says when we set monetary policy, we're supposed to stabilize prices and maximize employment. And that's the job. And that's not always easy, but it's simple to understand what the job is. And that's what we do with monetary policy. Because we're set up to not have political interference in the setting of the rates, we also try to avoid getting involved in fiscal policy. As I would say, it's 80-some degrees today. 3 days ago in Chicago, I think it was got down into the 30s. There is no bad weather. There is only bad clothing. And that applies to the city and the region and the Fed. The conditions, you tell us the conditions, and we figure out what's the right way to react to it. And fiscal policy goes in our bucket of these are the conditions that we're given. And there are a lot of, that's not the only thing that's going to change. I'm sure we'll talk about tariffs. I'm sure we'll talk about taxes. There are commodity prices, productivity growth, overheating, bubbles, zillions of things that change over time, and the Fed's job is to figure out what they mean.
So you've been president of the Chicago Fed for 2.5 years. What has surprised you the most in those 2.5 years?
Those were some dog years, that 2.5 years. I started in January of 23. We had a Silicon Valley banking crisis. We've had, on the highs and lows, surprise on the content were the banking crisis. In the rest of 23, the inflation rate fell by almost as much as it ever fell in a single year without a recession, which has never happened before. So that was positive. The surprise organizationally was I discovered when I got there that all the cash in the United States is printed by the Bureau of Engraving and Printing, but is distributed by the reserve banks. And we have giant vaults full of tens of billions of dollars of cash that we run through machines, and we pay out hundreds of millions a day in and out of to our member banks through these armored carriers. And I've been totally fascinated by that. So those are probably the biggest surprises.
Okay, so what are the data sets that you look at most closely and most impact your thinking on the current state of the economy? And how is fiscal and tariff policy uncertainty affecting the economic data that the Fed uses to make its decisions?
Ooh, yikes. Two huge areas in that question. When I got there, I professed to be a member of the Data Dog Caucus, that one of the key rules of the data dogs is sniff out all data sources. When you have uncertainty, go find more and more information. The key data components in the dual mandate, of course, are the job market, the unemployment rate, how many jobs are being created in any given month, and the various measures of inflation. That said, a lot of weird things have happened in the job market in the last 5 years, as you know. So it behooves us to look beyond just the headline big numbers like the unemployment rate and the number of jobs nationwide, to look at sectors, to look at a lot of private sector information, which has gotten to be more in real time than the official data. The thing to know about the official data is it comes out with a month or a quarter lag. So another major component of data sources that I monitor and that we monitor at Chicago Fed are coming out to talk to people. We had 36 or 38 business roundtables around the district, and we go out to try to get information in real time, especially at moments of transition. So then pivot to tariff policy, other fiscal policies. Here it just emphasizes how behind, if you only looked at the official data, you'd be behind the curve. So far, we've had the last 2 months excellent inflation reports, but when we're out talking to people, they're like, oh, just wait, the tariff, we haven't seen it yet, but the tariffs are coming. So we got to have a little bit of anticipation. I would say surprisingly little direct impact so far in the data that's coming out, but with the question mark, we don't know if that will remain true in the next month or two.
So along those lines, how is the Fed evaluating inflationary pressures, and what should businesses expect regarding interest rate policy yet this year?
Okay, I should have started with the rules say I'm not allowed to speak for the Fed or for anybody else on the committee. I'm only allowed to speak for me. I think that before April 2nd, the dual mandate was looking pretty good. The unemployment rate was around 4%, close to stable full employment, and the inflation rate which had gotten way, way too high, has been coming down steadily and looked to me like it was on path to get to 2%. So that is what made me say in the period before April 2nd, I thought rates can come down. Every quarter, all the members of the FOMC sitting around the table put out the statement of economic projections, okay, which is known colloquially as the dot plot. And in the dot plot, without names, they give it's not a forecast, it's a what do you think will be the appropriate rate, interest rate, and what do you think will be inflation, unemployment in these next year, the year after, and they ask about the long run. And if you look at the dot plot, a big majority of the committee thinks that rates are going to eventually settle well below where they are today. So that's why I was saying, hey, we're coming in with a nice landing. Rates are going to be a fair bit below where they are today if we come back in 12 to 18 months, what I said. Then we encounter some turbulence, some dirt in the air, I called it, that I think it's just a little harder to see exactly are we still on that path. But I still think underneath there, we basically are on that path. So we had our big Fed Listens event in Chicago. People came in from around the district. They expressed a lot of it was a construction firm in Iowa, actually, who said, hey, we're basically in a pencils down moment where we can't keep taking the test. We got to just wait to find out some information. But there was optimism too, that people thought on the back end of this thing, if we could open up some new markets, if it didn't turn into as big of a cost driver as the kind of the first round announcements made it look, if we could find some deals, et cetera, by the time the harvest came in the fall, in a way, it might be fine. So now I guess I still think I got to update the timing. So it used to be 12 to 18 months. Now it's 9.5 to 15.5 months or something. I still think if we can get past this bumpy period, that the dual mandate still looks pretty good to me, and I think we can be on that path.
So the phrase "Wall Street isn't the economy," highlights that stock market performance, which is what the Wall Street tracks, doesn't necessarily reflect the overall health of the broader economy. So how does the Fed gauge Wall Street, and is it just another economic data set to incorporate into your calculus?
I like that. It's a datum to put into our calculus. As not my very first speech that I gave at the Fed basically made the argument, let's pay attention to the dual mandate in the real economy. That's what the law says we're supposed to do. If the stock market or other markets help us inform that, that's great, but that's not the point of the policy. And the Wall Street is not the economy. I'll just give you one data point, which I find irrefutable. That one day in what it was like, the announcement day was May, about the month of April 2020. The day when they announced, I think 19 million jobs were lost in a single month. The worst day in the history of the US job market, where people were looking at each other like, are we going to be okay? Like, is the world going to come out? That day, the stock market went up on the announcement. Okay, they announced it was 19 million jobs were lost and the stock market went up. Okay, so you could say, yeah, that's because it was already priced in. But yeah, fine. But that's all you need to know. The stock market is not the economy. And the Fed's job by law is to think about the economy. And so that the stock market plays into business expectations, we should pay attention to it, but it sure, in my view, it certainly should not be driving what decisions we make.
So let's dive into a little bit into the Midwest economy. So what are the key economic trends shaping the Midwest, in 2025? And how does the region compare to the national economy? And can you dive a little bit into the ag economy as well?
Okay. So the 7th district is most of Iowa, Illinois, Wisconsin, Michigan, Indiana. That's basically heart of the Midwest, and that's what the district is. The two areas in which that district are different, distinct from the national economy, much more ag, much more manufacturing, and especially auto production. Ag and manufacturing are among the most internationally, would you say, exposure to the global economy. So in an analysis of the most tariff exposed states, 4 of the top 7 are in the district. And Iowa's very high on that list for both manufacturing and ag. That has made, especially manufacturing, being as cyclical as it is, that's often made the manufacturing economy in the 7th district kind of tip of the spear, canary in the coal mine style about the business cycle. So you would say, if you started to see manufacturing really encountering a difficult period, that might be a sign that recession is coming because it's more cyclical. And all of that got scrambled in this COVID and post-COVID period because the COVID recession was the first recession ever that was not driven by cyclical stuff, consumer durables, business investment, residential housing. Demand for TVs went up as the recession went in, and the thing that drove the recession was a bunch of stuff that's normally not even, there's normally recession proof, like elective surgeries and stuff like that. So coming out of a recession that was driven by a shift to physical goods and away from services, as now we've had a kind of a squeeze on manufacturing that was not really related to a normal business cycle. That's made it really confusing for the central bank and for anybody looking at the economy to figure out, well, so what comes next? Or what would be the impact of raising, holding, or cutting the interest rate? How interest rate sensitive is going to the dentist? Probably not that interest rate sensitive, and so it's kind of our normal calculations are thrown off a little bit. The ag economy is very tied, as you know, to will there be a retaliation? Will there be new trade deals? We still have a little bit of time before the harvests mostly come in. Farm income was extremely strong and then have suffered a bit. And you've seen in Iowa, our reports, it's been a kind of a tough year with costs rising, but the margin compression as the costs keep going up, but the sale prices somewhat of a cap on them. So we'll have to see how it plays out.
So back to manufacturing for a minute. How are
Yeah.
supply chains evolving post-pandemic, and how has your own thinking on supply chains evolved?
Very few people and very few macroeconomists had thought anything about supply chains before the pandemic. They just kind of assumed Econ 101 style, it'll change in cost goes through supply chain, supply costs factor into prices. But it was the origin of team transitory, where yes, inflation jumped, and people said, well, this will be transitory because it's just a supply chain disruption that'll just heal. They'll just fix it. And one of the lessons of 2020 was if the disruption is big enough, it doesn't just heal that quickly. And it spills over that there's no chips, so they can't make the electronic components. There's no electronic components, so they can't make a car. They can't make a car, then the people who are going to rent a car, the rental car can't replace the fleets. So the price of used cars starts going up. Then the people who want to rent a car, it's $700 a day to rent a car. And that spillover, then the people who were renting the cars, their costs are going up. That like spillover chain to chain takes way longer than I thought, than we, the economics profession, thought before COVID. Now the fear that I hear expressed when I'm just out talking to people, before April 2nd, they were saying, if we got tariffs on the order of magnitude of 25%, or, at one point on China it was going to be 145%, their fear was this is going to take us back to a kind of a 2021, 2022 period where costs are raging out of control, or if it's too big, it might take us back to the true supply disruption where we just couldn't even make the product. My read so far is it hasn't been that. And everybody kind of keeping their fingers crossed that we don't get to that. But that was like the construction guy saying, it's just put the pencils down and let's just make sure that that we don't get tied up.
So let's talk a little bit about the 800-pound gorilla in the room, tariffs, right?
Okay.
So when have tariffs been used effectively, if ever?
Okay.
Help us understand how other countries treat U.S. companies with regards to tariffs in various ways to help their domestic companies better compete with U.S. companies and their products. And then I'll give you a recent quote from General Motors CEO Mary Barra, who said, "For decades now, it's not been a level playing field for us automakers globally with either tariffs or non-tariff trade barriers. So I think tariffs is one tool that the administration can use to level the playing field."
Okay, I'm going to start. You're tempting me very much. As I was a research economist 30 years at the University of Chicago. You're never going to find somebody who's going to out free trade me. Okay. And all economists are unanimous. They do not like tariffs. Now, that said, that's a fiscal policy. If the Congress and the president want to put in tariffs, that is 100% their purview. That's not monetary policy. We're just going to figure out that goes into the conditions. If you say anything that affects prices or employment, the law requires us to think about it. And the thing about tariffs is they raise prices. And the more sophisticated thing that we got to decide is if something raised prices one time and stopped raising them. So if you put in a 10% tariff, pure theory, Econ 101 version would say you'd have 10% inflation on all imported goods for 1 year, and then there would be no more inflation. That'd just be a one-time increase to the price level. So the central bank, knowing that that's a transitory, and I use that phrase sheepishly, but also accurately, that if you think that it's a transitory shock to inflation, there is a sense in which you should just ignore it when setting the money. But you shouldn't be trying to fight that because it's not a lasting inflation shock. But now it rolls us back to your previous question. We learned the last time around that this thing hit the supply chain, and the central bank said, well, that's probably transitory. Then 2 years later, we're still dealing with the inflation, and everybody's like, you idiots, how could you have thought that was going to be transitory? So personally, I'm a little gun shy about making that argument again before we know how big is this shock going to be, and things that in our phraseology are supply shocks, which is to say things that lead you in a stagflationary direction where employment gets worse and prices go up at the same time. That's the worst kind of thing that the Fed ever has to deal with because there's not an obvious playbook. If the economy's overheating so that unemployment is going down while prices are going up, you cool the economy by raising the interest rates. And if it goes the other way, so inflation's coming down and unemployment's going up, you try to juice the economy by loosening. But the stagflationary direction, it partly depends, well, which side of this dual mandate is getting worse, and how long is each side supposed to last?
So last month, the Consumer Price Index measure of inflation was released at an increase of 2.3%, if I'm not mistaken. What should people and businesses make of this current data?
Not to get too far in the weeds, everybody knows the Consumer Price Index. That's like a bundle of goods that they set ahead of time, and they just check the prices on that bundle. The Fed has identified that we have a 2% inflation target, not on CPI inflation, but personal consumption expenditure inflation, which is just a slightly different measure. It's more expansive. Instead of being a basket of goods, it's on everything we spend money on. That, in the last month, the backward-looking average over the last year is 2.1%. So it's pretty close, but you don't just be looking in the rear view mirror. It all matters what's coming in. I think that's the last vestige. Do you ever tape the basketball game with hoping to watch it the next day? And you just like, don't tell me, I don't want to know. In this one, the fear is we already know that this is with a 1 month lag and it's backward looking. So the tariff impacts haven't shown up yet. But I think these last months of inflation look pretty good to me. They're why I thought underneath there, this thing was looking decent on dual mandate grounds. I thought it's a path back to 2%. So whether that will continue to be true depends a lot on what happens now on the policy side.
So let's talk a little bit about labor. What is your assessment of the labor market? Are we seeing signs of a slowdown or continued strength? And how do you see new immigration policies impacting the labor market?
So far, we haven't seen slowdown. Like I say, if you look at the broadest measures of the job market, not just the unemployment rate, take the ratio of vacancies to unemployed workers, look at the hiring rates, the quit rates, et cetera. It pretty generally points to a strong, healthy, full employment kind of a labor market. You haven't seen any significant upticks in new unemployment claims or anticipated layoffs or things that would be indicators of imminent downturn. It doesn't mean it's impossible, but the labor market has remained pretty strong. That came out of the hottest, most unsustainable labor market that we had ever experienced. Now, this looks like what you would want it to look like. I mean, very sustainable, strong wage growth, faster than inflation, high productivity growth in the private sector, and fairly stable at that kind of level.
So these next two questions are kind of tied together, and you may not want to answer one of them. But how worried are you about the national debt? And do you care to comment on the big, beautiful bill currently being debated in Washington, D.C.?
Look, the fiscal policy are the conditions that we take as given, and the size of the debt as a share of GDP. You don't want to just look at it in the absolute levels. A share of GDP times the interest rate, kind of what's the debt service ratio. I think that does affect the long rates, the 30-year Treasury rates, and things of that nature. But again, those are not under the control of monetary policy of the Fed. The Chair Powell said, they asked Chair Powell something like that, and he said, A, we don't set fiscal policy. B, the long-run fiscal trajectory of the country, that's not a sustainable path, but it's like Congress and the president and the American people are going to have to figure that one out. if there is a note of optimism, it would only be if you compare the US situation to a lot of the other advanced countries of the world, our debt to GDP ratio started lower. Our demographic change is less, the aging of our population is less pronounced than in most of the other advanced economies. Those other economies already have 20-25% national VAT sales taxes and income tax rates higher than where the US rate is. So people characterize that as maybe we're still the cleanest of the dirty shirts, but I do think it's worth thinking about the debt capacity of the US in general before concluding about what would happen to interest rates. And I've always said that the problem of debt and deficits, in my view, is not so much that it's going to lead to an short run fiscal crisis, Greece style in the US, where the interest rate's going to go way up. The problem is you have to pay back the money. And so over time, just a greater and greater share of our government spending is going to go to interest to pay off the debts that we're incurring today. And kids born in 2025 are likely going to have to pay a lot higher share of their lifetime income in taxes than people that were born in 1965 or 1985. And that's, I don't know, that's weird. You know, if you think of it in a generational context, I find that weird.
So talk a little bit about housing and its importance to the economy, especially in light of the national median price of a home being 431,000 compared to just 258,000 in 2019, a gain of about 67%.
Yikes. The thing about that is the that number is colored by the median house size, quality, and location is varying over time. So can you can you can get misleading information if you go too general. Housing is a key cyclical component, so it's one that I think about and people Fed think about a lot. Construction, housing, they're very interest rate sensitive. That they've gotten in the short run less interest rate sensitive as more and more mortgages have been 30-year fixed mortgages, not adjustable rate mortgages. So when the interest rate changes, the fixed rate more if you had the same rate fixed for 30 years, actually it led to a little bit of this lock-in effect that as rates went up, people said, well, I'm not going to move if I can at all help it because I don't want to give up this fabulous rate that I have, you know, and then I have to go from 3.5 to 6.5 or 8.5%. Now that said, the housing affordability crunch, maybe even crisis, has been extreme. If you look at all the components of inflation, what's been the most persistent and the most puzzling? It's been housing inflation. Now that's finally starting to change, but this divergence between goods inflation, like you walk into Target or Costco or something, what are the price of the stuff you see versus the price of buying a house? That's been an extreme case in the last 2 or 3 years of housing inflation high, goods inflation low. But that's not new in the last 2 or 3 years. That's been true at a different level for like 15 or 20 years. We had the entire 2000s, we had about 2% inflation, not because inflation was the same and everywhere 2%. Housing inflation was like 4% a year, and goods inflation was like minus 1% a year. So it, it doesn't take the QCBJ luncheon level of sophistication to recognize that something that compounds 5% a year for 20 years is going to be really different but at the end of that. And if you look at the relative price of housing, it's very expensive. So when young people today express frustration, they say, "Why my dad had we had only one, he had one job, and we could afford this big house, and I can't even buy a condo now. And and I'm married, and we got two jobs. They're not wrong. They're not wrong. Some of that's probably from building regulations, and that it's made it harder to build housing. Um, but that change in the relative price of goods versus housing, I think, is a big explainer of why the numbers are moving like
So, what challenges and opportunities do you see for mid-market companies in the region, and how can they best position themselves for success?
that. It partly depends what industry you're in. Um, Historically, the kinds of things that matter a lot to mid-market companies are what are the aggregate economic conditions facing the whole economy, and what are the credit conditions. Both of those are up in the air question marks. I was going to say we've had a pretty solid growth period, um, where the biggest challenge facing mid-market companies has been on the cost side, that the cost of production coming from inflation and coming from supply chain disruption began to dominate in the surveys. If you ask people, what are your biggest concerns for operating your business? Those have been dominant in a way that healthcare costs, wage costs, and some of those were historically paramount. I would say the mid-market companies in the Quad Cities area, to the extent that we're more oriented to ag and manufacturing, these issues of call it geopolitics or fiscal policy kind of choices are going to be more impactful, and whether there is retaliation from other countries is going to be more impactful to the short to medium run uh, operations. So unfortunately, we've all got to a buckle our seatbelts, but b become experts in geopolitics and understanding what will be the reaction in some of these other countries.
Okay, two last questions. I'm going to talk a little bit about AI. How transformative is AI in your thinking about now and the future, especially with regards to productivity and jobs?
I'm undecided. It sounds very promising. There's been one of the brightest spots of the economy in the last 2 years has been the surge of productivity growth in the private sector in the United States. And that's led economists trying to, so output per worker or output per hour have gone up at rates that are a fair bit well above what trend productivity was for 10 years plus before pandemic. And the economists have been trying to figure out why that is an issue. Should we expect it to continue, or is it a one time? And there's some group of people who are like, well, there was a one time bump up in hybrid work, so you people could match to better jobs, and we've had a surge of labor force participation. But if you look at the industries where the productivity growth has increased the most, they are in a bunch of industries where AI is starting to be used. So one part of me is skeptical that AI could explain why productivity is up because it's just not big enough yet. It's a small share of the economy. But when the Federal Reserve Bank of Chicago researchers showed me this analysis of where productivity growth is up the most, that started me thinking maybe there is some technology. I don't know if it's exactly Chat GPT, and I will say that my personal experience with the AI overview on Google is less than perfect. It's good running about a two-thirds wrong answer kind of a thing. Um, but so far in the data, there are tantalizing prospects that could be good. And if so, yes, we'll need to sort out certain jobs will be more replaced by AI than others. It will have impact on what trajectory and what careers people choose. But make no doubt about it, the thing that made the U.S. the richest nation in the world is innovation and productivity growth. That's how we got rich. And if we got amazing productivity growth from AI that would allow the service sectors of this country to have the kind of productivity growth that manufacturing has had, that will be amazing. We will be richer than we have ever been before, and that'd be very exciting.
Okay, last question. A little bit about economic theory. I think we want to dive in on this
Ooh.
last because you talked a little bit about geeking out on that earlier. So, is it an interesting time in the study of economics, specifically in the wake of the pandemic? Are we going through a novel time, or is there precedence in your research? I think specifically about the inverted yield curve and industries like the trucking industry, and how it is usually an indicator of the national economy. That industry has been struggling mightily for more than 3 years, but no recession has resulted yet.
Okay. My dad, I love the trucking, and my dad was for all his career before he died in the truck trailer manufacturing business. And I have multiple uncles and grandparents who were truck drivers, and so that's an industry that was close to my heart. Um, and it has always been a leading indicator of the business cycle, as have a number of other things like temporary employment, like temp agencies, very good indicator. The inversion of the yield curve. So if the long rates were actually lower than the short rate, that was a 100% indicator that recession was coming. We could go through a list of a bunch of others. Almost all of them broke down for predicting the COVID recession or coming out of the COVID downturn. They were saying, wow, there's definitely going to be a recession. The yield inverted. It remained inverted for 2.5 years. And for 2.5 years, people kept saying, oh, it's about to happen. It's about to happen. And it didn't. I think that's because this was such a unique kind of premise of the question. This was a totally bizarro business cycle, as we talked about before. And it's why I've said all along, everybody who's expressing confidence, oh, I know what's about to happen, you should immediately discount what they say because they don't know. No, this has never happened before. It's why I was less nervous that the Chat GPT and the AI was going to replace the Fed. There were people saying that the stupid Fed, they don't know anything. We should have an LLM do it. The LLM is only as good as a training sample. And if you plugged in before 2023, how can we get inflation down? Inflation raging out of control. How will it come down? It would 100% have said, jack the interest rate up to 15%, let unemployment go to double digits, and that is the only way that you ever get inflation. And it would be wrong. We got inflation down as much as it ever went down in 1 year without that. The unemployment rate never even got to 4% in 2023 um, because this was such a weird time. Now, I don't know that that means any of the lessons that we learned will be applicable in the future. And in a way, I hope and pray that they aren't. Let us never do that again. You know what I mean? But if we enter periods with a lot of supply shock, I do think there are some lessons. Then it would be less abnormal. If there is any historical parallels, if there are any historical parallels, and they're only cousins at best. They're definitely not twins. They would be the oil shocks that we experienced in the 1970s, or maybe the coming out of World War II, when there were a lot of supply disruptions and things of that nature.
Let me give Austin a round of applause.
Thank you.
Thank you so much for your
Yeah,
time.
thanks for having me.